Some of the riskiest portfolios I see are the ones labeled safe. On paper, everything looks diversified. Multiple asset classes, professional management, global exposure. But many portfolios look diversified in normal markets. Under stress, they reveal how concentrated they really are. I'm David Harris, founder of Alternative Investment Advisors. This show is for high net worth investors who want more than conventional allocation, more than market-dependent planning, and more than surface-level diversification. Most advisors allocate products. We architect outcomes. Diversification may be the most overused and least examined word in modern portfolio construction. We've been taught to diversify by asset label, stocks, bonds, international, maybe alternatives. But real diversification happens at the driver level. What actually causes the return? What creates the risk? That is where portfolio design becomes architecture. In periods of stress, correlations between asset classes historically increase. Assets that are supposed to offset each other start moving together. In these stressed markets, investors often discover they owned many positions, but not many truly different outcomes. Most portfolios are diversified by label, not by behavior. When your income, your equity, and your portfolio are all influenced by the same economic headwinds, you aren't protected. You are concentrated in disguise. Let's talk about the structural cost of staying conventional. The average investor worries about returns, but for many affluent investors, the greatest leak in the system is not always volatility. It is friction, tax friction, timing friction, and forced exposure to public market cycles. When your strategy doesn't account for these forces, you're losing a significant portion of your engine's power before it ever reaches your bottom line. It's not just about a market dip. It's about sequence risk, the danger of your lifestyle needs or tax liabilities aligning with a market downturn. That alignment can permanently impair long-term wealth. Traditional portfolios often rely on being right at the right time. But markets don't reward consistency, they test it. If you are forced to exit or rebalance based on a public market timeline rather than your own, the system isn't working for you. You're working for the system. So instead of trying to predict markets, what is part of your portfolio was built on return drivers that had nothing to do with daily market pricing? A resilient portfolio is not built by owning more tickers. It is built by introducing different return engines. This is where alternative strategies create a structural advantage by tapping into fundamentally different sources of growth. The income engine. Private credit can create contract-based cash flow. Unlike public bonds that fluctuate with interest rate sentiment, these are direct agreements that prioritize consistent yield. The efficiency engine. Certain real estate strategies may improve tax efficiency through depreciation. This turns a physical asset into a tax shield, protecting more of what the portfolio earns. The non-correlated engine. Legal finance follows case outcomes, not stock market sentiment. Because a court's ruling isn't tied to the S&P 500, it provides a return source that is truly decoupled from the broader economy. When you architect a portfolio this way, you move beyond the surface asset labels and look at what is actually powering the performance. True diversification is not about how many holdings you own. It is about how many different economic drivers you own. That is how you introduce stability under pressure. One client came in highly concentrated, career risk, equity risk, and portfolio risk all tied to the same economic cycle. The issue was not just volatility, it was structural dependence. By introducing strategies driven by different return sources, we improved optionality and reduced the emotional pressure to react during market stress. It wasn't just about the numbers on the dashboard. It was about the system finally working for him rather than against him. A well-built portfolio should do more than appreciate. It should remain functional under pressure. It should account for complexity, absorb volatility, and give you options when others feel stuck. For high net worth investors, that's not a luxury, it's a requirement. There's no template for this, because your situation isn't standard. But there is a more architectural way to build. If this conversation exposed a weakness in how your portfolio is actually built, the next step is a focused portfolio architecture conversation. A 20-minute consultation to identify where your portfolio may be diversified on paper, but concentrated in behavior. If your portfolio looks diversified, but still feels exposed, schedule your 20-minute consultation.